$15 trillion. Gone. Vanished in what some are calling the most statistically impossible market event in recorded history. And if you think that sounds crazy, wait until you hear what happened next. Because what we witnessed this past Friday in the metals market, followed by this weekend's absolute destruction in crypto, might not be coincidence at all. Stay with me, because by the end of this video, you're going to see the financial system in a completely different light. Welcome to Money Aftermath, where we don't sugarcoat the markets and we definitely don't sell you dreams. I'm here to break down what's really happening behind the scenes, while mainstream media feeds you distractions. Before we dive deep into this financial earthquake, do me a favor. If you're serious about understanding where your money's really going, and you want unfiltered market analysis that actually respects your intelligence, hit that subscribe button right now. Only about 1 in 4 of you watching are subscribed, and honestly, that tells me most of you are still testing the waters. But if you want to be part of a community that sees through the manipulation before it hits your portfolio, subscribe now. And drop a comment below telling me where you're watching from. That engagement helps this channel reach more people who need to hear the truth. Now, let's get into what just happened. We're talking about a market movement so extreme that mathematically, it shouldn't occur in the entire lifespan of our universe. $15 trillion wiped out across gold, silver, and cryptocurrency markets combined. Gold dropped 15%. Silver crashed 38%. And in the crypto space, we saw $500 billion evaporate in just 3 days. To put that in perspective, that's roughly half of the entire United States GDP disappearing in a single trading session. This wasn't a normal correction. This wasn't profit-taking. This was something else entirely. And the data tells a story that should make every single person watching this video very, very concerned about what's coming next. And let me paint the picture for you. Friday morning, precious metals traders woke up to absolute carnage. Silver, which had been climbing steadily, suddenly nosedived 31% in a matter of hours. Gold fell nearly 14%. $7 trillion in value, just gone from the precious metals markets alone. And here's where it gets interesting. When you dig into the data, you find something fascinating. JP Morgan, one of the largest banks in the world, closed 633 silver short contracts at the exact bottom of that crash. Think about that timing for a second. The exact bottom, not near the bottom, not around the bottom. The precise lowest point of the entire move. Does that sound like luck to you? Because it doesn't sound like luck to me. Then, as if Friday's metals massacre wasn't enough, the weekend brought complete devastation to the cryptocurrency markets. Bitcoin dropped 13%, erasing $265 billion from its market cap. Ethereum plunged 25%, losing $91 billion in value. XRP fell 22%. Solana crashed 23%. And this created the 10th largest liquidation event in cryptocurrency history, with $2.5 billion worth of leveraged long positions getting absolutely destroyed in just 24 hours. Now, before we go any further, let me be crystal clear about something. I don't sell trading signals. I don't offer mentorship programs. I don't have courses to push on you. What I do is analyze market data from multiple perspectives and present you with information that you can use alongside your own judgment and research. This channel is for independent thinkers who understand that nobody, and I mean nobody, should be making your financial decisions for you. If you're looking for someone to tell you exactly when to buy and when to sell, this isn't the place for you. Trading and investing require you to think for yourself, do your own research, and understand the risks involved. Also, quick warning. There are fake accounts out there stealing content from channels like mine and repackaging analysis with completely made-up numbers and fake recommendations. I'm not responsible for what those accounts do. Always verify you're following the real Money Aftermath channel. Don't let scammers take advantage of you during times like these. So here's the question that should be on everyone's mind right now. We had metals crash on Friday. Crypto destroyed over the weekend. Are these events connected? Is this some kind of financial contagion spreading across different asset classes? Or is this evidence of something more coordinated, more intentional, happening behind the scenes? Let me break down what happened with silver, because understanding this is crucial to understanding everything else. The Chicago Mercantile Exchange raised margin requirements to 11% on January 28th. Now, if you're not familiar with how futures trading works, let me explain what this means in practical terms. Traders who had opened long positions, meaning they were betting silver would go up, suddenly needed to post dramatically more cash as collateral. People who had entered positions requiring $25,000 in margin suddenly had to come up with $66,000 when silver hit $120 per ounce. What happens when traders can't meet those margin calls? Forced liquidation. They get kicked out of their positions whether they want to or not. Their contracts get sold at whatever the current market price is, regardless of how low that price has dropped. And when hundreds or thousands of these forced liquidations happen simultaneously, it creates a cascading effect that drives prices even lower, triggering even more margin calls, creating even more forced selling. And right at the bottom of all that chaos, right when silver hit its lowest point around $78, JP Morgan's February delivery data shows them closing a massive short position by buying from all those forced sellers. They effectively bought at the absolute bottom from traders who had no choice but to sell. Meanwhile, something fascinating was happening in the physical markets. Buyers in China and India, who represent massive demand for physical silver, refused to participate at those crashed prices. They didn't see $78 silver as a bargain they needed to jump on. They saw it as artificial price manipulation and stayed on the sidelines. This creates a really dangerous setup for anyone still holding short positions, because if the major banks have covered their shorts and physical demand remains strong, there's a lot less downward pressure to keep prices suppressed when they start moving back up. Now let's talk about what's happening in cryptocurrency right now, because the parallels are striking. Bitcoin dropped below $79,000 this weekend. The immediate cause is what market analysts call a liquidity crisis. We've seen 3 distinct liquidation waves totaling approximately $1.3 billion over the past 12 hours. When you combine that kind of extreme leverage with market sentiment that swings wildly between extreme greed and extreme fear, you get these massive air pockets where prices just drop through levels that would normally provide support. And here's a detail that should grab your attention. Michael Saylor's company Strategy, which has become famous for its massive Bitcoin holdings, is now less than 2% away from being underwater on its entire position. Think about what that means. Strategy holds over 700,000 Bitcoin that they acquired at an average price of $76,038. At Bitcoin's peak of 126,000, their holdings were worth $81 billion. But if Bitcoin drops below 74,600, Saylor's entire strategy goes into the red. That's not just a number on a screen. That's a psychological threshold that could trigger panic selling from retail investors who view Saylor as a Bitcoin visionary. Let me give you some context on how significant this liquidation event is. The October 10th crash saw $19.1 billion in liquidations. The COVID crash in March 2020 saw $1.2 billion. The FTX collapse triggered $1.6 billion in liquidations. This weekend's crypto crash resulted in $2.51 billion in liquidations, making it the 10th largest liquidation event in cryptocurrency's entire history. And it's happening immediately after the largest metals crash on record. Does that timing seem random to you? Now here's where this gets even more interesting, and I want you to really think about this. While $15 trillion is being liquidated from gold, silver, and crypto markets, what is dominating the news cycle? Epstein files being released, World War III fears being amplified, Iran tensions escalating, mainstream media flooding every channel with stories designed to capture attention and trigger emotional responses. So ask yourself this question: where did that $15 trillion actually go? Money doesn't just vanish into thin air, it gets transferred. When you sell an asset, someone else is buying it. When prices crash, someone is on the other side of those trades profiting from the movement. While everyone's attention was focused on scandals and war threats, massive amounts of wealth changed hands in the financial markets. Some of you might be thinking this sounds like conspiracy theory territory. But let me show you why this is just pattern recognition based on observable data. Markets aren't just influenced by natural supply and demand anymore. They're managed, they're manipulated, and in some cases, they're deliberately engineered to transfer wealth from retail traders to institutional players who have better information, better technology, and the ability to move markets with their order flow. Speaking of geopolitical tensions, let's address the Iran situation because it's directly impacting market sentiment. Recent reports indicate that the United States has deployed additional military assets to the region. Qatar's foreign minister reportedly delivered what's being described as a final message to Iran's leadership. These aren't just headlines. These are developments that markets interpret as increased geopolitical risk, and when risk increases, traders typically sell volatile assets and move to cash or traditional safe havens. Except here's the problem. Even traditional safe havens like gold got hit during Friday's crash. Why? Because in the initial phase of a liquidity crisis, everything gets sold. Traders need to raise cash to meet margin calls or reduce exposure, so they sell whatever they can, even assets that should theoretically be holding value or increasing in value during times of uncertainty. And speaking of system stress, we just saw the first bank failure of 2026. After 7 months without a bank going under, we now have Metropolitan Capital becoming insolvent. Now, some analysts are dismissing this as an isolated incident. But if you remember how the 2008 financial crisis unfolded, it started exactly like this. Small banks failed first, everyone said it was contained, then more banks failed. Then the contagion spread, then the entire system nearly collapsed, taking trillions in wealth and millions of jobs with it. I'm not saying we're definitely heading for another 2008. What I am saying is that the warning signs are there, and ignoring them because you don't want to seem pessimistic is how people end up completely unprepared when things get worse. $3 trillion knocked out in minutes across multiple asset classes. This isn't normal market volatility. This is something more significant happening. And the question we need to be asking is whether regulatory agencies like the SEC or CFTC are investigating any of this, or if we're just supposed to accept that markets can be this manipulated without any consequences. So, what happens Monday? Let me give you two scenarios and understand that both are possible depending on how various factors play out over the next 24 hours. The bearish scenario goes like this. If what we're witnessing is a genuine liquidity crisis spreading from metals to crypto to equities, Monday could bring even more damage. Asian markets open first, several hours before US markets. If China, Japan, and Hong Kong all gap down significantly, that sets a negative tone for European trading, which then carries into the US session. In this scenario, we see continued contagion across asset classes, more crypto liquidations as people wake up Monday morning to losses and panic sell, more margin calls across all markets. If Michael Saylor's Bitcoin position goes underwater, and that becomes a major headline, it could trigger additional selling from investors who lose confidence. If rumors spread about more banks being in trouble after Metropolitan Capital's failure, confidence in the financial system cracks further. The flight to cash intensifies. Everything gets sold as liquidity dries up even more. If Iran tensions escalate over the weekend with any kind of military incident or failed diplomacy, Monday opens with panic. Oil prices spike, equity markets crash, risk-off sentiment dominates everything. The 15 trillion that got erased could become 20 trillion, 30 trillion, as the selling cascades. And here's the critical point for precious metals investors. Even though gold and silver are supposed to be safe havens, in the initial phase of a crisis driven by margin calls and liquidity needs, even they can get hit as people scramble for cash. The safe haven bid comes later, during phase 2 of a crisis, but phase 1 can last days or even weeks in extreme situations. The CME could raise margins again on Monday, triggering more forced selling in metals and more liquidations. The paper price could drop even further while physical premiums explode higher. We're already seeing Shanghai premiums at 43% above COMEX prices. If COMEX drops more while Shanghai holds or rises, that premium could hit 50%. At some point, the COMEX pricing mechanism loses all credibility because it's so disconnected from physical reality. But getting to that point could be extremely painful for anyone holding paper positions. That's the bearish Monday scenario. Now let me give you the bullish case because it's equally possible based on what we know. If JP Morgan and other major banks successfully covered their short positions at the bottom of Friday's crash, there's now far less short interest available to suppress the next move higher in precious metals. Physical holders in China and India refuse to sell at $78 to $90. They're holding their positions. Delivery demand remains strong at over 2,500 contracts for February. Physical markets are tight. If Asian markets stabilize Monday, if the liquidations stop, if margin calls ease, we could see an extremely violent move back up. Short positions are covered, physical supply is tight. Shanghai premiums at 43% are screaming that paper prices are disconnected from physical reality. The rebound could be fast and brutal as short covering meets physical demand in a market with reduced supply. We've seen this pattern before in precious metals. Massive flush lower, then explosive recovery. China's export controls that took effect January 1st are reducing available supply. India absorbed 25% of global silver production in 2025 with demand that doesn't decrease when prices fluctuate. The physical fundamentals remain extremely strong. If the paper liquidation is complete, if weak hands have been flushed out, the path higher reopens with significantly less resistance. Mining stocks could double over the next 4 to 6 months as this situation resolves and the bull market resumes. Cryptocurrency could bounce Monday if the liquidations are finished. 3 liquidation waves totaling $1.3 billion might have cleared out all the over-leveraged positions. If Bitcoin holds 79,000, if Saylor doesn't go underwater, market confidence could stabilize. Sentiment shifts from extreme fear back to cautious optimism. Liquidity returns, prices recover. Iran tensions could de-escalate if the diplomatic message delivered by Qatar leads to productive negotiations. If there's no military incident over the weekend, if diplomacy succeeds, the geopolitical risk premium comes out of the market and risk appetite returns. Assets rebound across the board. And here's the really interesting possibility. If this was deliberate manipulation, as the data strongly suggests with JP Morgan exiting at the exact bottom and 15 trillion being erased while media provides convenient distractions, then the manipulators might be done. They got what they wanted. Weak hands flushed out, short positions covered, market positioning reset exactly where they wanted. Now they step back and let prices run higher. Monday could be green across all markets as the next phase of the bull market begins. But let me tell you what I'm specifically watching to determine which scenario is more likely. Shanghai futures markets open Sunday night U.S. time. If Shanghai silver holds firm or actually rises while COMEX is closed, that tells us physical markets are not panicking and Asian buyers see value at these levels. If Shanghai gaps down hard and follows COMEX lower, that indicates selling pressure is global and real, not just a U.S. or Western market phenomenon. The Asian Open will set the tone for Monday's trading. Bitcoin's action over the weekend is crucial. If it stabilizes around 79,000 and holds that level, maybe even bounces to 82 or 85,000, that's bullish for Monday's risk appetite. If it breaks below 75,000 and Sailor goes underwater, that's bearish and could trigger another wave of panic selling. Cryptocurrency price action right now is functioning as a leading indicator for Monday's overall market sentiment. Iran news over the weekend matters enormously. Any military strikes, incidents, or escalations would be bearish for Monday. Any diplomatic progress, de-escalation, or positive developments would be bullish. Geopolitical news moves markets dramatically, especially when tensions are already this elevated. Bank news is another key factor. If more banks are rumored to be in trouble, if there are emergency weekend meetings, if FDIC is stepping in anywhere else, that's bearish for Monday and suggests metropolitan capital wasn't isolated. If no other banks are failing, and this appears to be a contained incident, market confidence holds up better. Before we wrap up, I want to make sure you understand 3 critical takeaways from everything we've discussed. First, $15 trillion erased from gold, silver, and crypto combined represents what's being called the first Sigma 10 event in financial history for metals markets, combined with the 10th largest crypto liquidation ever recorded. This is not normal market behavior. This represents system-level stress. JP Morgan exited massive short positions at the exact bottom on Friday. Crypto liquidated all weekend. The question for Monday is whether this liquidation continues or if it's finished. Watch Shanghai's opening Sunday night and Bitcoin's price action through the weekend for clues. Second, the disconnect between physical and paper markets is at extreme levels. Shanghai premiums are 43% above COMEX, while COMEX prices crashed. Physical holders in China and India are refusing to sell at any price. Delivery demand remains strong. Because here's the truth that nobody in mainstream finance wants to admit. The vast majority of retail traders and investors lose money, not because they're stupid, not because they don't work hard, but because the game is rigged against them in ways they don't fully understand. Institutional players have better information, faster execution, larger capital bases, and the ability to influence markets in ways retail traders cannot. Understanding that reality doesn't mean you can't succeed. It means you need to be smarter about how you operate. One of the ways retail traders consistently lose money is by being overleveraged at exactly the wrong time. They see an asset moving up and they get greedy. They want to maximize their gains, so they use margin or leverage to amplify their position size. And when that asset is moving in their favor, it feels like genius. They're making more money faster than they ever have before. But then the move reverses. And because they're leveraged, their losses are amplified just as much as their gains were. And if the move is severe enough, they get margin called and liquidated at a massive loss. This is exactly what happened to billions of dollars worth of positions this weekend. Traders who were leveraged long in crypto, thinking Bitcoin was going to continue its run to new highs, got absolutely destroyed when the price reversed. And many of them didn't have a choice about when they exited their positions. The exchange or broker liquidated them automatically when their account equity fell below the required maintenance margin. Here's what I want you to understand about Monday. Regardless of which scenario plays out, there will be opportunities. If markets continue crashing, there will be opportunities to position for the eventual rebound at better prices. If markets bounce hard, there will be opportunities to capitalize on that momentum. But you can only take advantage of opportunities if you're still in the game. If you've been liquidated or if you've panic sold at the bottom, you miss the recovery entirely. This is why I keep emphasizing risk management and position sizing. It's not exciting. It's not the part of trading that gets your adrenaline pumping. But it's the difference between surviving volatile markets and being another statistic of someone who blew up their account during a crisis. And let's talk about something else that's crucial to understand right now, the relationship between paper markets and physical markets and precious metals. When you buy a gold or silver futures contract, you're not actually buying physical metal in most cases. You're buying a paper contract that represents the right to take delivery of physical metal at a future date. But the vast majority of these contracts never result in physical delivery. They get closed out before expiration, with the trader either taking a profit or loss on the price movement. This creates a situation where the paper market can become disconnected from the physical market. If there's extreme selling pressure in the paper market due to margin calls and liquidations, the paper price can drop even while physical metal becomes harder to obtain and commands higher premiums. This is exactly what we're seeing right now with Shanghai premiums at 43% above COMEX prices. What this tells us is that the crash in paper prices doesn't necessarily reflect actual supply and demand for physical metal. It reflects forced selling by leveraged traders who need to close positions to meet margin calls. Physical buyers who understand this dynamic are staying on the sidelines, waiting for the paper market to stabilize before they step in. And when they do step in, if physical supply is as tight as the data suggests, we could see a very sharp reversal higher. But timing that reversal is extremely difficult. This is why blindly trying to catch the bottom is so dangerous. You might be right about the direction eventually, but if you enter too early and the liquidations continue, you could be the one getting margin called before the recovery happens. Better to wait for confirmation that the selling pressure has exhausted itself, even if that means missing the absolute bottom. Now, I want to circle back to the geopolitical situation because this is having a direct impact on market psychology. When you have military deployments, diplomatic ultimatums, and escalating rhetoric between nations, markets interpret that as increased uncertainty, and markets hate uncertainty. Uncertainty makes institutional investors reduce their risk exposure. It makes retail traders nervous. It creates an environment where the default action is to sell first and ask questions later. What's particularly concerning about the current Iran situation is that it's happening at the same time as these massive market dislocations. Under normal circumstances, geopolitical tensions might cause a flight to safe haven assets like gold. But when you have forced liquidations happening across multiple markets, even safe havens can get sold as traders raise cash. This creates temporary mispricings that eventually correct. But getting through that temporary period can be extremely painful if you're positioned wrong. If diplomatic efforts succeed and tensions de-escalate over the weekend, you could see a relief rally Monday as that risk premium comes out of the market. But if there's any kind of military incident or failed diplomacy, Monday could open with significant gap downs across all risk assets. This is why watching the news flow over the weekend is so important for positioning. Let me also address the bank failure situation, because this deserves more attention than it's getting. Metropolitan Capital going under might seem like a small regional bank issue that doesn't affect most people. But in 2008, that's exactly how it started. Small banks failed first. Everyone said it was contained. The mainstream narrative was that these were isolated incidents, and the financial system as a whole was sound. And then more banks failed. And then major institutions like Bear Stearns and Lehman Brothers collapsed. And then the entire global financial system nearly imploded. I'm not saying we're definitely heading for another 2008 scenario, but I am saying that dismissing bank failures as isolated incidents without understanding the systemic connections is how people get caught completely unprepared. Banks are interconnected through the financial system in complex ways. One bank's failure can create problems for other banks that had exposure to it. And in an environment where liquidity is already stressed, those problems can cascade quickly. If we start seeing more bank failures over the next few weeks, that would be a strong signal that something more systemic is breaking down. If Metropolitan Capital remains an isolated incident and no other banks follow, then maybe this was just one poorly managed institution. But we won't know which scenario we're in until we see what happens next. This is why having some portion of your wealth in physical assets that exist outside the banking system makes sense. Not because banks are definitely going to fail, but because if they do, having all your wealth trapped inside a failing institution is a really bad position to be in. Diversification isn't just about having different stocks or different cryptocurrencies. It's about having different types of assets held in different ways. Let me give you one more thing to think about as we head into Monday. Market psychology tends to follow a pattern during major dislocations. First, there's the initial shock and panic selling. Then there's a period of uncertainty where people try to assess damage and figure out what happened. Then there's either continued selling if the news gets worse, or a sharp recovery if the news stabilizes or improves. We're currently in that uncertainty phase. The initial shock has happened, the damage is being assessed. What happens Monday depends largely on whether we get more negative developments or whether things stabilize. This is why I laid out both the bearish and bullish scenarios for you. Both are possible. Both have supporting data. Which one manifests depends on factors that are still unfolding. Your job as a trader or investor is not to predict with certainty which scenario will play out. Your job is to be prepared for either scenario and to position yourself in a way that you can survive and potentially profit regardless of which way things go. That might mean reducing position sizes to levels where you can handle more volatility. It might mean keeping more cash on the sidelines so you can deploy it opportunistically. It might mean using stop losses to define your maximum acceptable risk on any position. What it definitely doesn't mean is going all in on a high conviction bet that Monday will definitely go one direction or the other. Because if you're wrong and you're over leveraged, you could lose a significant portion of your capital in a single session. And recovering from large losses is exponentially harder than avoiding them in the first place. I know this isn't the exciting, adrenaline-pumping content that tells you to buy this coin or short that stock, but this is the content that actually helps you survive and thrive in markets over the long term. The most successful traders I know aren't the ones making huge bets and hoping they're right. They're the ones managing risk carefully, sizing positions appropriately, and being patient enough to wait for the best opportunities rather than forcing trades when conditions are uncertain. Before I let you go, I want to emphasize one more time how important your engagement is for this channel. YouTube's algorithm determines how many people see these videos based on how current viewers interact with them. If you watch the entire video, that signals to the algorithm that the content is valuable and worth showing to more people. If you like the video, leave a comment and share it with others. That amplifies that signal even more. So if you've made it this far, thank you for watching. Hit that like button right now. Drop a comment below with your thoughts on Monday's market direction. Share this video with anyone you know who needs to understand what's happening. And if you're not subscribed yet, subscribe now and turn on notifications so you don't miss the follow-up coverage when we see how Monday actually plays out. The next 24 hours are going to tell us an enormous amount about market direction for the coming weeks and months. Shanghai opens Sunday night. Bitcoin is trading through the weekend. Iran situation could develop at any time. Bank news could break. We're in a critical moment, and having accurate information and clear analysis is more valuable than ever. Stay disciplined, stay focused. Don't let emotions drive your decisions. Watch the data points I mentioned. And remember, the goal isn't to predict the future with certainty. The goal is to position yourself in a way that you can handle whatever the future brings and take advantage of opportunities when they present themselves. Remember, invest with logic, not emotion. Do your own research, understand your risk, and never ever put yourself in a position where a margin call can wipe you out. This is Money Aftermath, where we cut through the noise and show you what's really happening. I'll see you in the next video with updates on how Monday unfolds. Stay safe out there.